Now, it's been a good day at the office for the stock market players, and then recently I surveyed the FNArena website and pulled out some stocks that the analysts like. But does FNArena's founder, Rudy Philippek van Dijk, like what his analysts like? We'll soon find out. Welcome, Rudy.
I like the fact that they've become my analysts.
That's right. You've never really owned them, but if they're on your site, you can claim ownership.
Yeah, probably, yes.
Okay, Rudy. Well, you and I often talk about lots of strange things in this segment. One quick one. What we saw happen today clearly was Janet Yellen driven.
Yes.
Is this going to set the scene for stocks to rise this year, or do you think we're stuck in this volatility trading range?
I think we will stay volatile for quite a while. I actually think the market is quite confused here, Peter. And I think the confusion stems from the fact that sometimes things look alike, but they're not really the same. And in this case, we're going from a phase where we had extreme central bank policies, and we're now moving to less extreme central bank policies. Now, some people are talking about tightening. Tightening is something really different. That is maybe around the corner, somewhere in the future. At this point in time, we're talking more about normalization, less extreme, and that's the confusion in the market, I believe. 2
weeks ago, central bankers came out and said something. Well, Mario Draghi was probably the starting point, and the bond market sort of took off. I was critical of the bond market, and of course, all the bond market lovers out there, and there are a lot of them, kind of thought I was, creating, sacrilegious insults on the bond market, but they overreacted, didn't they?
Absolutely. And okay, bond markets moving up, that is one thing. Expecting that this will continue, that's another thing. And of course, what we always tend to forget is they come from such low levels. I mean, the German bonds, for example, not that long ago, they were negative. Now they're 0.5%. Yeah. Okay, if you look at the price chart, that looks really, really scary. And yes, it spooks a few people, and yes, some asset prices, maybe they were a little bit too high. But all in all, I tend to agree with your underlying thesis. I think the market is getting spooked about too much, and if anything, it's confused also because the market always looks back at the past. In the past, we needed inflation for central bankers to come into action. Now there's no inflation. I don't think there's inflation on the horizon, and I think we will remain in a low inflation level for quite a while here. But it doesn't mean by definition that extreme stimulus measures by central banks are here to stay forever and ever. And now we're moving to a phase which should be a positive. It means that economies no longer deserve to be supported by extreme measures. So we're now going what I would call normalizing a little bit. We're still stimulatory, but we don't do the extreme things anymore. And that should be regarded as a positive thing. For some reason, it scares people. It's, for the time being, not seen as a positive.
Okay, let's talk about some stocks. As I said, I looked at some of the stocks that a lot of your analysts liked, and also a lot of other fund managers are talking to me about these sorts of companies. So I'd be intrigued to see what you think. Let's start with Aristocrat.
All right, one of my favorites, Peter. I think I've mentioned the company a couple of times while I was on your program. I am a shareholder, and I intend to remain a shareholder for quite a while. Sometimes, and this is actually quite interesting that you mentioned this company, because a lot of people wouldn't look at it because it's officially trading on a P above 20. Now that for some people means that it's expensive. I'm always of the view that you cannot judge a stock by a PE ratio in isolation. This is one of those multi-year growth stories. Everything is falling into place for them. If you're really, really anal about it, Aristocrat was $3 5-6 years ago. It's now 21, I believe. So you see the gains are massive. Now, even with those gains, you still can't judge a stock whether it's overvalued or not. The only thing you can safely assume is that sometimes profit taking kicks in. We probably have seen that from $24 to 21. But again, if you take a longer term view, then this is a blip. The big fans of the stock, and that I can add the likes of Goldman Sachs locally to that, and Citi, They actually believe that this share price is headed for $30. At 21, it's a steal.
Okay, let's go to Aurora.
And one of my other favorites. You're very good at this one.
This is the first night we've been such in sympathy with each other. We go on.
Just for people who may not realize this and think like, what kind of exotic animal are we talking about? This is actually ex-Amcor. Amcor, a couple of years, decided to spin off their local operations. So this is cardboard boxes and
Plastic,
PET flash bottles and things like, and packaging around, but stuff you find in the supermarkets. The share price has been, I'm a long-term shareholder. I've done well, and I intend to do well. It's a very resilient type of business, which is why I like it. And I mean, I like Amcor more, but I like it's not bad to be number 2 after Amcor in that sector. They have American exposure. They have acquisition plans. They have a lot of growth built in because Amcor did the investments before they spun off. The disadvantage at this point in time, that's why it's come back a little bit. There is a new factory being built in New Zealand, and it scares a few people because they think that might increase competition in New Zealand. They are suffering from higher electricity prices. Unfortunately, they can't take up a manufacturing facility and just move it elsewhere. So they're a little bit victim to margin pressure because they, unfortunately, just like you and me, have to pay their bills when to AGL or Origin or one of the other ones. And that has sort of depressed the share price a little bit. Again, I would think that a company like Aurora has a long-term future ahead of itself. So if there is a short-term blip, medium-term blip like we are experiencing now, long-term investors, I would say, should definitely have a look at the share price.
Yeah, and a pretty impressive CEO as well. Let's go to ResMed.
You're getting better at this. I mean, I often talk about all-weather stocks, and I think Aurora is one, and I think ResMed probably deserves to be on that list as well. The difference with ResMed and the Aristocrats and the Auroras we just mentioned is that ResMed is probably close to its annual year high here, maybe an all-time high. So I would actually, I mean, it's one of those beautiful, high-quality stories we have on the ASX, and we should cherish them, and really appreciate them for the longer run as well. If you were a shareholder in past years, and I invite everyone to take a longer-term view and go back 10 years, 12 years, 15 years for ResMed, I mean, you'd be smiling all the way from here to the bank and back. And there's no reason why that should not be the case in the decade ahead. I mean, I was a little bit cautious in the past because that sector also is changing, but it would appear that management is making all the right moves, all the right changes. ResMed remains a top tier in what it does in its markets. And the future just looks.
Let's take on the Amazon fear with the Super Retail Group.
Well, see, that's now you're getting now the quality is dropping. I think yes. See, at face value, and this is where I think a lot of investors make mistakes. Sometimes cheaper priced companies make a better return going forward than higher priced companies, but that's not always the case. And a lot of times, a company that is higher priced, relative basis, deserves to be higher priced. ResMed would be an example. Sometimes companies that are lower priced deserve to be lower priced. And I think Super Retail is one of them. Forget about Amazon for the time being. I believe that consumer spending in Australia is looking a little bit wobbly, a little bit shaky. And retailers, and that's basically what Super Retail is, they are going to feel a pinch. How much? We don't know. We have to see that in August. And the Super Retail is also, because that's where I guess most people know it from, is from the car parts operation. It's the annoying ads on television. I know that sector because I own Bapcor, and there is some pressure in that sector because the number 3 who's being squeezed out, Repco, they're price discounting. So the expectation in the market is that both Super Retail and Bapcor, somehow have to match that and will face pressure on the margins. I'm not so sure whether that's 100% correct, but we'll find out in August.
Yep.
In the meantime, fishing gear, tents,
Sporting gear.
yes, I'm not very keen on that exposure. And then we haven't even seen Amazon coming a little bit down the track. So for me, it's maybe a trading stock, but I wouldn't go in there with a long-term.
More a short-term play than a long-term play. I might run out of time. Let's go to Domino's. A lot of people are wondering whether, because and I've got to say, Don May's coming on the program. I always love a CEO showing up. Usually means that they've got some good news. Let's just see if that works out. What do you think of it, Domino's?
Well, Domino's is one of those examples where a high PE stock that had everything going for itself, then all of a sudden comes a little bit unstuck, and then yes, the share price deflation can have a pronounced impact. There's a very good reason for that. The good news story has hit a few bumps. There's definitely, I would think there's a given margin pressure at Domino's. That's why now you get stories about they're cutting a little bit off their pizzas, for example. And they're switching from Coca-Cola to Pepsi, and that's all because of the margin pressure. They're obviously trying to preserve the margin. Now, that can still work out very well, including their cheap staff and the franchisees and everything. That can work out well. At the moment, I believe the risk is too high because it still remains a high PE stock, and I would rather see them coming over those bumps, and then I'm not afraid then to buy maybe in at a higher share price. But at this point,
so you want to hear the earnings show and tell, and if it's good, you will jump on board.
Yes, I would like more security, because if they do come out with a disappointing report, the market can really savage.
It'll be kind.
Yes.
All right, mate. Fantastic. Really, Philip Van Dyke from FNArena. Thanks for joining us.
Peter.
So coming up, one of the pioneers of the ETF industry, Graham Tuckwell, who's an extraordinary Australian success story.